Good morning, everyone. Welcome to an episode of the Mizuho Week Ahead. I'm Boon Heng, market economist at Mizuho Bank. This week's theme is creative destruction. The risk-off environment was certainly evident last week. Despite a higher than expected ADP and ISM services print, markets were spooked by the sharp spike in job cut announcements. While AI-related tech valuations were also doubted last week, markets appear muddled around the impact of technology and the associated creative destruction. Amid the technology adoption, productivity gains measured by the most rudimentary output per worker will inevitably be realized in some roles or sectors by lowering the denominator, even though the optimists will point out that higher capital-labor ratios may also result in higher productivity. As such, markets will persist to swing from one end of hopes of AI-driven productivity to job destruction fears. Across the Atlantic, the Bank of England's policy rate hold came amid a very tight vote, with Governor Bailey casting the deciding vote for a 5-4 rate hold, saying that they need to be sure inflation is on track before they cut again. In Asia, yen gains also reflected the risk-off backdrop amid the softer USD yields. Furthermore, firm wage growth and robust wage negotiations in Japan, alongside still healthy household spending growth, has retained rate hike prospects. Nonetheless, falling real wages continue to be a bugbear for the BOJ. In the Philippines, Q3 GDP disappointed at 4% year-on-year, which was significantly below expectations. Notably, headlines of a loss of investor confidence appears stretched, especially for this print. Specifically, the 2.8% year-on-year decline in investment spending came on the back of a 25% year-on-year decline in government spending in construction investments, which more than accounts for the entirety of the decline in investment spending. In short, this appears to be more of a stalling of public sector projects amid the corruption probe, rather than an outright private sector or foreign capital flight. In Australia, the RBA stood pat as widely expected, as Governor Bullock explicitly said that a cut was not discussed at this meeting, and she even alluded to the possibility that there is no more rate cuts left. Even as markets adjust to this possibility, they remain skeptical, retaining about the possibility of about one cut by H2 2026. This though could all turn quickly should the job report disappoint on the 13th of November. Our view is that while the base case is for the unemployment rate to edge lower on participation rate adjustments, this is mere statistical relief should employment gains remain weak. Consequently, we are wary of the risk that even a decline in the unemployment rate to 4.4% may be insufficient for Aussie dollar boost. In Malaysia, the Bank Negara Malaysia kept its unchanged last week amid the better-than-expected growth performance. Undeniably, the ringgit has outperformed regional peers on the back of BNM's prolonged pause until possible signs of an inflection in global trade. Even as we enter a data-light week, investors will assess the appropriate risk pricing in an AI-led exuberance. We are also kicking off this week with renewed hopes of the end to the US government shutdown, and equity futures are starting the week higher. For more information, please refer to our Week Ahead publication or contact your respective sales desk and RMs. And for regular notification on our market views, please subscribe to our channel and hit the notification button. Thank you.